Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about all the things you should start thinking about or consider or contemplate as you approach retirement, and probably start thinking about some of these things maybe 5-ish years as you're leading into retirement. Now, of course, there might be a whole host of issues that you might need to consider that are specific to your situation. So today, all I'm going to do is talk about, obviously, the most common ones, but please don't take this as an exhaustive list, nor, of course, like anything, is it a substitute for personal advice. Of course, you need to, consider what I'm telling you, whether it applies to your situation. The other caveat that I'd like to just flag just now is, we tend to deal almost exclusively, or probably exclusively, with self-funded retirees or people that will eventually become self-funded. So I'm not going to talk about any kind of Centrelink strategies here today, but if you are within those sort of means tested limits, so there's income test and asset test, for you to be able to get some support, whether that's the aged care pension, those sorts of things. There could be a whole bunch of additional things that I'm not going to talk about today that could help you maximize some of those benefits. And it's great then to deal with a specialist in that area. That is not our firm. That's not our wheelhouse, but we can certainly refer you to someone if you need that kind of advice. So in no particular order, I'm going to talk about, as I said, the common things that we start thinking about for clients and we do for clients as they approach retirement. And the first one that I want to talk about is the resetting of interest-only terms. And this is particularly relevant for, obviously, investment debt. So that's if clients have an investment property or they've been gearing against shares or something along those lines. Now, most lenders have maximum interest-only periods of 5 years. And so, of course, when we go and set up a new mortgage, the loan term is 30 years. And if you have an interest-only term, it means that the first 5 years will be interest-only. The remaining 25 will be principal and interest. Most lenders also allow, once you've completed that first 5-year term, to roll over for a second 5-year term, which means that the remaining loan term after those 2 interest-only periods is 20 years, of course. Most lenders then don't allow you to roll over for any more interest-only terms. And I can imagine the reason for that would mean that you're compressing the remaining contracted period for which you're obligated to repay that loan. And if that period is too small, too short, obviously loan repayments need to be ridiculously high and they won't be able to prove that. Borrowers will be able to make those repayments. So that means that once you've had 2 interest-only terms, essentially what you need to do is go and refinance to a new bank. Now, you can't necessarily refinance when you're, in your 70s, for instance. Not only will age be a consideration from a credit policy perspective, but you might not have the income and asset base to obviously meet the credit criteria at that particular point in time. So then what we like to do for clients is we like to refresh loan terms. Now, sometimes we can do that at their existing lender, depending on their circumstances, but quite often it means switching to a brand new lender so you can have, therefore, a fresh 30-year loan term, which then means that we're going to most likely, nothing's set in stone, credit policy can change, bank policies can change, but as it stands today, it means that we're going to be able to have at least 10 years of interest-only repayments. And to my mind, that's really important because what it does is it allows me to put money in my offset account, and that will actually help my cash flow. Because obviously interest-only repayments are based on the interest that you owe the bank with respect to that particular month. And if you've got a lot of money in offset account, your repayment is going to be low. If you shift some of that money out of the offset account, of course, then you'll incur more interest and your repayments go up. But the benefit of interest only is that I can manipulate the amount that I need to repay. Whereas on a principal interest loan, even if I've got a lot of money in the offset account, the principal interest repayment, the dollar value repayment is fixed because that's a contracted repayment. That is, it's in the contract. So therefore, if my client retires at 60, for instance, we're going to have interest only for 10 years. They'll be 70 at the time. When they're 70, we can then decide what we're going to do. And naturally, we'll have a plan around debt reduction, debt management. That could mean, sell a property at 70. It might mean repaying the loans. So, if they're fully offset anyway, we might just close those loans out. But whatever it is, we've got a decade of a runway to sort of work out what we want to do and to be able to manage our cash flow over that time. So when should you do that? Well, you should complete the refinance or complete the loan restructure probably around about 6 months before you give notice to your employer or before you cease work, whichever is the sooner. And I say 6 months only just because it shouldn't take that long, of course, but you just don't put yourself under any time pressure. And if you're going to go back to your existing lender, give yourself time to work out whether that's going to work. And if it's not going to work, then you're going to need some extra time to refinance to a completely new lender. I think 6 months should be more than enough time for you to be able to sort of work that through. Now, I should mention that refinancing or changing lenders and loans and restructuring after you are retired isn't necessarily off the table, by the way. So we've got a bunch of clients that are in retirement and we still, refinance their loans and make changes. It's just a little bit tighter. Banks will look for two things. Firstly, they need to be able to prove serviceability. So there's you've got enough income to repay. They will rely on super pensions. And if they're financial planning clients of ours, we can write a letter to the bank to say, look, this is what we intend to draw from super. And they'll rely on that income in terms of servicing loans. And the other thing that they tend to seek advice on is exit strategy. And typically they want a letter from an accountant or financial advisor to sort of say, well, okay, what is the long-term strategy here? How are we going to manage this debt? How are we going to exit this debt over time? So it's not impossible to refinance loans when you're retired. It really depends on your circumstances. And that's another thing that a mortgage broker should be able to help you with this sort of advice in terms of working out, is it absolutely critical that you need to do this restructure before you retire, before you give notice? Or, do we feel pretty confident that we're going to have the capacity to be able to make those changes even after retirement? Okay, so the next thing we'll talk about or think about is insurance cover. So I'm talking about personal risk protection insurance here. I'm talking about things like income protection, life and TPD insurance. Of course, these insurances tend to be quite critical when we're at the beginning of our wealth building journey and while we're working. Quite often, our long-term investment strategy is premised on the assumption that we're going to be able to get out of bed every morning and go to work and earn an income. And that income will then generate some surplus amount that we're able then to contribute to retirement through super contributions, funding negative gearing, investing in shares, and all those sorts of things. So if we are no longer able to get out of bed for an extended period of time, of course, that's going to retard our ability to build wealth, and therefore that's why we need the insurance. But as we get closer to the retirement date, the risk is reduced because hopefully we've done most of the heavy lifting already, and in that we've got a good investment balance compounding in the background. Doesn't necessarily require or may not require a lot of contributions from ourselves. And when we're thinking about what are we insuring, if we're insuring our future income for income protection purposes, for instance, well, if I'm 30, then I'm insuring 35 years of income. That's a huge asset and a hugely important asset. It makes sense. But if I'm, 59, I'm only insuring the next 6 years of income. It's a completely different proposition, particularly if I've already got an established asset base. So my view would be at least sort of 5 years approaching retirement, that depending on your situation, we would start paring back risk protection insurance. We would probably reduce TPD insurance first, just because it covers a narrower risk, if you like. Income protection is probably the last one to reduce, just because it's tax effective, it's tax deductible, the premium is, so the after-tax cost isn't as significant, and it tends to be the kind of the key one that we're trying to protect in terms of our ability to earn an income. And life cover, the question needs to be asked, if one spouse passed away, is there enough assets? Are there enough assets so the surviving spouse is going to be in a comfortable position? If the answer is yes, then the answer is get rid of your life cover, or at least reduce it substantially so you can reduce the cost. But hopefully we have zero insurance by the time we get to retirement, and really probably around 5 to 10 years leading up to retirement, we would start gradually paring back that cover, if it's appropriate to do so, depending on obviously the client's circumstances and their asset position. But that's something you need to start thinking about as you approach retirement. The next tip is really review your banking. And this has sort of come from a conversation I had recently with a client. It might be more difficult to make banking changes once you're in retirement, like applying for credit cards or a new car loan, these sorts of things. If those things it need some changes, you're better off to make those changes while you're working than necessarily trying to navigate those changes post-working. It kind of ties in, I guess, to the interest-only loan thing, but really, I guess, generally banking as a whole. You just need to ask yourself, are any of these things going to be difficult to change when I'm not working? If so, you might want to think about making those changes sooner rather than later. Next thing to think about is there anything you need to change in your portfolio or from investments that are going to give rise to a capital gain? Because if there is, you might actually be better off delaying making those changes until after you're retired, if it's at all possible. Now, this is a difficult one, right? Because if I'm thinking about, for example, selling down an investment because I think that investment is fully priced and I want to take some profit off the table, on one hand, I might go, well, if I don't do it today and I do it in 2 years' time, I'll save a lot of tax. On the other hand, the value might change, but in fact, it's almost certain it was going to change between now and in 2 years' time, and it could be positive or negative for you. So you've got to balance these sorts of things out. But certainly if we've got a client where we've said, okay, this property, it's not a great asset, or we need to sell an asset in order to reduce debt and help fund retirement and so forth, we will typically try and, as much as possible, try and delay the sale so that you can minimize capital gains tax. And that could, if you've got sort of zero taxable income in retirement, that could save you over $33,000 if by delaying it, if that capital gain is substantial. So it's well worthwhile to do. The other thing then is if you do then expect a capital gains tax event to occur in retirement and your super balance is less than 500,000 and you anticipate it will be once you're in retirement as well, the other strategy would be to minimize as much as possible any concessional contributions in the 5 years leading up to retirement. And the reason I say that is that what that means then in that first year of retirement, if you crystallize the capital gain, you can then go back 5 years and make up catch-up concessional contributions that are tax deductible. And it's just a way, I guess, of kind of shifting some of that money inside super, claiming a personal tax deduction for making those contributions, and therefore minimize the amount of tax that you might end up paying on that capital gains tax liability. But planning around capital gains, there's some important considerations there. The next thing to think about is your retirement date. And again, this is tax driven as well. So for clients that have a lot of leave accruals, and that could be annual leave and long service leave, for instance, well, they'd be better off retiring on 1 July than 30 June, for instance. Retire on 30 June, all those leave accruals will be paid out in your final pay in one tax year. You'll probably end up being, if there's substantial benefits there, you'll end up probably paying the highest marginal tax rate. Whereas if you retire on 1 July and then all that leave is paid out on 1 July, of course, the next pay period, whenever that might be, at least that income then shifts into a new tax year. If you don't have a lot of substantial sort of payouts and leave payouts and so forth, well, then end of calendar year tends to be a pretty good time to retire, because at least half of your income, 6 months of your income will go into one tax year, and that could help you out as well in terms of minimizing tax. But just something to think about, I guess, in terms of what payments and income you might receive prior to retiring and after retiring. Next thing we think about is making sure super is ready for retirement. So, the first thing to think about is how your super balance is invested. Arguably, as you move into retirement, and particularly the deeper you get into retirement, capital preservation becomes a little bit more important than investment returns. And for some people, a lot more important than investment returns. And therefore, adopting a more conservative asset allocation might be more useful. Now, if you have a high risk profile, a high tolerance for risk, and if you're worried that you might not have as much assets as you need, then the reverse could be true. Maybe you still adopt a relatively aggressive asset allocation, knowing that you might experience volatility, but over the long run, you'll maximize returns. It's just interesting. If I cast my mind back 16 to 17 years ago when the global financial crisis happened, there was a lot of commentary and articles in the paper about people having to delay retirement by 5+ years or something like that. And that's because they had just sort of too much invested in equity markets at that time. Of course, they crashed. The equity markets fell by about 50% when the GFC happened. And, that's a case of being overinvested for your age and stage of life. So, if you don't think you can stomach a 50% drop in equity markets, then you need to make some changes to your asset allocation. And specifically, if you're saying, well, I'm going to retire because my super balance is X and I've got these other assets and etc., you're making a decision based on that data. If that data was to change and your decision was to change, then you don't really have the capacity to wear any volatility, in which case then you should actually reduce the risk profile in your asset allocation. The other thing too, if your super is on a wrap platform or in a self-managed super fund, you want to think about the liquidity of your investment portfolio and just making sure that you're able to pay a pension and you've got enough assets to be able to pay a pension. And then also you want to think about making sure that you're providing for any volatility as well, depending on the asset allocation. So we tend to like to have 2 or 3 years of pension payments in a relatively stable sort of defensive asset base. Now, that still might be wisely invested, of course, but so it's not just sitting in cash, but something that's relatively capital stable so we can ride out any market volatility. Next thing we would think about is a super recontribution strategy. So this is applicable if you're older than 60 and still working. What we might do in those sort of situations is start a transition to retirement pension, which allows you to withdraw 10% of your super balance each year. And that income is tax-free, again, as long as you're over 60. And then you could recontribute it either into your spouse's super or your own accounts. And so there's two reasons here, or two different reasons you might do that. So recontributing into your spouse's account, you would do that to try and even up balances between you and your spouse. And the reason you want to have relatively even balances is that everyone has what's called a transfer balance cap, which is the amount that you can have in super that is going to be tax-free, entirely tax-free. That's $1.9 million each. So there's no point then one spouse having, say, $3 million of super, $2.5 million of super, and the other spouse having $500,000. Of course, you're not fully utilizing or enjoying all those cap limits. And so the spouse with the higher super balance would start a transition to retirement pension, draw out 10% each year, and then recontribute it into their spouse's account to try and even up those balances. Alternatively, you can recontribute it into your own super. And the reason you might do that is just trying to reduce any potential taxes that your beneficiaries might pay in your estate. So a super balance essentially consists of two components, a tax-free component and a taxable component. The taxable component really is from concessional contributions and other rollovers and those sorts of things. For most people are going to have a relatively high taxable balance. And that means that if you then leave your super either via your estate or via a death benefit nomination, leave your super to non-financial dependents, such as adult children, for instance, which is pretty common, then the taxable component will be taxed at 17%. So they'll have to pay 17% in tax. Whereas if you start a recontribution strategy, transition to retirement, recontribute 10%, take out 10%, put that 10% back in. 10% is calculated as a non-concessional contribution, so you can recontribute up to $120,000 a year, depending on your super balance, and that'll go to the tax-free portion. So it's just a way of, I guess, recycling what is taxable back to tax-free. This is a really complex part of, superannuation strategy. There's, so many caps and limits and rules around it. So I only highlight it as something to think about. If you were in a situation where you and your spouse have completely different balances in super, so unequal, very unequal, or you're concerned about, what tax your beneficiaries might have to pay, it might be worth looking into some of these strategies and in particular, getting some personalized advice around it, as I said, because it is pretty complex. Now, the last tip I want to share with you is, what does retirement look like for you? And I mean, it's a financial planning thing, but it's also a bit of a lifestyle decision. So Most of my clients, they don't intend to just stop work completely on one day. So, they're working full time this week and then next week, bang, no work at all. Most people anticipate a sort of staged retirement, sort of ease into it if you like. And there's a couple of really key important benefits to this. I mean, the first one, the financial planning one, is that earning an income in retirement, even if it's nowhere near the income that you earned when you were before you retired, it does have a huge compounding impact because it means that we need to draw less on your investment balances and allows them to compound longer. So, for example, if I had a client that had a very high income, $400,000, let's say, and they're working away, building a good asset base, and then they entered into retirement. They were spending, let's say, $150,000 a year, but they were able to go and earn $100,000 just by doing some part-time work or project work or something like that. That's going to have a huge impact because all we need from the asset base then is to top them up an extra $50,000 to help pay living expenses. As opposed to if they weren't doing that work, we'd need $150,000. It eats into returns and income and compounding more than it would otherwise. So it is really valuable if you can earn a little bit of income. You might retire at 60 and then do a little bit of work between 60 and 65. It can have a huge compounding financial impact. Secondly, there's potential major, certainly health and even mental health benefits. There's a UK study that I've spoken about a couple of times, which concluded that the likelihood of experiencing clinical depression in the first year of retirement, it was around about 40% probability, which is significantly higher than the normal population, about 28%. I guess the thing that work helps us with is sort of social connection, provides us sort of learning opportunities to kind of stretch our skills and so forth. And then we're contributing to something that's larger than ourselves, which gives us a strong sense of purpose. And, quite often it's part of our identity in terms of what we do. And so therefore, sort of easing into retirement and letting that sort of transition happen, just gradually over time rather than sort of cold turkey, there can be some great benefits there as well. So I guess that's something as you approach retirement or wanting to retire, you've got to really think and ask yourself, well, what does that look like? And where am I going to fulfill some of those needs in terms of social connection and growth and then contributing to something beyond yourself, those sorts of things, because you can do without them for maybe the first year, do a bit of travel, all those sorts of things. But at some point, most people say, I'm going to get bored, so I need to have something else to sort of focus on. So there you go. They're the common things that we like to think about as our clients lead up to retirement. As I said at the beginning, there could be additional factors that you need to consider that are specific to your situation, but at least that gives you just a bit of a high-level idea of what we think about for some clients. Okay, so let's get into some listener questions. The first one is from Dave, and I'm just going to paraphrase a little bit Dave's question. Dave's question relates to episode 314, where I must have spoken about managing risk and making sure that you've got enough cash in defensive investments, relatively capital stable investments so you can ride out any volatility. And it's kind of perfect timing, Dave, to answer this question because it does to some degree relate to what I've just spoken about in today's topic. Okay, so, and he's asking about, how do you really use this buffer? Where's the tolerance? So I guess what I would be doing is I would say, okay, if I'm going to spend $120,000 a year, 3 times 120 obviously is 360. I want 360, at least 360 of my balance to be in something, an investment that I think is going to be relatively capital stable. So that could be something like there's a great hybrid ETF, HBRD, that we use that would sort of fit that mold. There's some interest rate hedged bond ETFs that you could use, which means that you don't have that interest rate change exposure that impacts value. Those sorts of investments is kind of what I'm thinking about. So where I'm still going to pick up maybe in today's market somewhere between 6 and 7% in terms of income and maybe a small capital return over time. So I'm still going to get a decent return on it, but I know that it's capital stable. I can sell it any time. I could liquidate the full asset, the full 360 if I wanted to tomorrow. It's always going to be there. And then Dave's question relates to, okay, but if you do then experience a market volatility, what is your tolerance around maintaining that 3 years buffer? Okay, so this is the way I would see it, that when the GFC happened 16, 17 years ago, it took about a couple of years for the market to recover. Actually, it's worse than that. I think it took 5 years in the US for the market to get back to its point, but it staged most of its recovery for about 2 to 3 years. And that was a kind of unique, I mean, that's a substantial shock, right? I mean, it's different in COVID when the COVID crash happened in, I think it was end of February 20. By the time we got to the middle of that year, markets were, I think, higher than what they were before that correction. So that was a very quick recovery. The way I would look at it is I would be happy to use all of those cash buffers. So that is, I'd be happy to delay selling any other assets for 3 years. So I'm happy to go to zero in terms of cash buffer if it helps me delay selling assets. My argument would be that it's probably very unlikely, right? If you get into that scenario, there's going to be something in your portfolio that you're going to be able to sell. So whether it's in the US market, in the Aussie market, in emerging markets, wherever it might be, I'm sure there's something that's going to be fairly valued before that, before you get to zero in terms of cash buffer. But the whole idea is to try and delay selling in a depressed market. But if the market starts recovering, or you think it's fairly valued, or you just don't want to sell anything that's grossly undervalued, and you want to ride that out as long as possible, Dave. So that's the way we would use. That's why I say 3 years. 3 years is going to be more than enough, most likely. There's going to be something to sell, most likely within a 3 year period. But I would have the tolerance to run that sort of buffer down to zero if I needed to. But it's just going to depend on what's going on in the market and how markets are behaving and how markets are priced and those sorts of things. But I think if you look back over the last 100 years, if you had 3 years to ride out a market, you're not going to be in a position where you're going to have to sell and take a huge haircut on valuations or anything like that. Okay, next question is from Yana. Yana asks about retirement pension bonuses that some of the industry funds pay. Yana was saying that she's currently with CBUS and she's thinking about moving to UniSuper because that's what I've spoken about as I think is the best of the industry funds, just because of investment returns, investment transparency, and very low percentage-based fees. But she noted that UniSuper doesn't offer this pension bonus. So what some funds are doing is they will try and give you a bonus. It's up to about 0.5% of your balance. But I mean, there's a lot of caveats around it and you might not get the full 0.5%, but something of that order. And the idea around it is to sort of compensate you for the fact that you've paid capital gains tax along the way. But if you hadn't have done that, there wouldn't be, you would get around that capital gains tax. I've spoken about this, with wrap platforms or self-managed super funds. If you're in your 30s and you go and invest in an ETF, for example, by the time, and you hold that ETF for the next 30 years, by the time you get to 60, it's going to have a lot of unrealized capital gains. If you then roll your super into pension phase, those gains disappear. So there's a huge tax advantage there that the industry funds don't have. And so their response to that is to start paying these bonuses, which, it's whole questionable about it. And so I guess to answer Yana's question, Yana was saying, well, what would you do if I was in my shoes? Would you still just go to UniSuper? Would you set up a self-managed super fund or wrap platform? All those sorts of things. So when select a super fund, you're going to have to think about a lot of different things, and not one particular item is going to be necessarily most important. They're all very important. So of course you want to think about investment transparency and management. So the transparency around investments. And if you're with CBUS, of course, they've been in the news recently for all the wrong reasons. And in fact, even ASIC or APRA is I think it's ASIC is suing them. So, when the regulator sues a super fund, that's, I think, cause for concern. So, if I was in your shoes, I probably would be looking to move on from CBUS. The next thing you're going to think about are investment returns. Now, of course, we can look at past returns, but nothing says that they're going to be repeated. But I guess it's probably the best of any evidence of what future returns might be. Fees, you're going to have to consider fees. And then I guess you could add the retirement bonus as a fourth item as something to think about. But just because one fund pays a bonus and the other one doesn't, wouldn't in of itself mean that that is a better fund. I do note that Australian Super has a balance boost booster, they call it. Same sort of thing. So it pays one. I think Australian Super and UniSuper are pretty evenly matched. I think UniSuper is slightly better. But if you go back to my Super Returns podcast in 23, I think I concluded that both Aussie Super and UniSuper were kind of neck and neck. So if you're really keen on a fund that had those sort of bonuses, Yana, I'd probably go to Aussie Super. I guess the thing is, though, you might have left it too late because I'd imagine it's going to be dependent on years of membership with that fund. And also for people that are thinking about, how do my investments behave when I transfer it into super and can I maximize tax benefits? If you're 5 to 10 years away from retirement, you probably left it too late. It's really something for people to be thinking about when they're in their 30s and 40s, because that's the time where, you need that long length of time to really accumulate those unrealized gains to be able to benefit from something like that. So that's my answer, Yana. Don't get too hung up on these things. You've got to balance it all out. If you go to a fund that pays you a retirement bonus, they might end up costing you in terms of higher fees, poor performance, or something along those lines. Okay, thank you very much for everyone that submits their questions. We're going to get through a whole heap of them. If you have any questions or feedback, send them to questions@investopoly.com.au. Please share this episode if you know of anyone that's approaching retirement. I mean, even if you're very young and your parents are in the situation of approaching retirement, please share the episode with them. The more that people benefit, the better I feel about it, to be honest. Okay, and so that's it for me for today. Until next week, bye for now.